Good morning. Treasury Secretary Scott Bessent stood in New York on June 25th and praised the biggest tech companies for investing $750 billion into AI this year. He compared it favorably to the dot-com boom. Meanwhile, inside his own department, a document was sitting on his desk. A draft Treasury report compares the AI market directly to the dot-com bust and concludes AI companies are more deeply embedded in the US economy than dot-com firms ever were. A downturn, the analysts wrote, would send shockwaves through stock markets, private credit, data centers, cloud providers, chip makers, and utilities all at once. So which is it exactly? A new golden age or dot-com number 2? So who's actually spending this money? Hyperscalers are the handful of giant cloud companies that run the physical data centers powering all of this. Their capital spending, capex for short, has gone from $100 billion in 2023 to over $300 billion in 2025. Goldman Sachs projects hyperscaler capex from 2025 to 2027 will hit over $1.15 trillion, more than double the prior 3 years combined. Capex now eats up 45 to 57% of these companies' revenues, a historically unthinkable amount. They raised over $108 billion in debt in 2025 alone, with $1.5 trillion projected over the next few years. On June 1st, Alphabet announced an $80 billion stock sale, upsized to $84.75 billion the next day, including a $10 billion private placement from Berkshire Hathaway, specifically to fund AI infrastructure. Alphabet isn't raising this because it's short on cash. It's raising it because the buildout got too large to fund any other way. Now, on the demand side, where the story gets even stranger. AI companies bill by the token, the basic unit they use to measure and charge for computing power. For over a year, tokens were subsidized, cheap enough that companies barely noticed the cost. That era is ending. On June 1st, GitHub Copilot switched from flat monthly pricing to metered per token billing. Developers reported bills jumping up to 25 times overnight, and one user's monthly cost went from around $50 to $3,000. Uber's CTO revealed in April the company burned through its entire annual AI budget in 4 months, driven by Claude Code adoption across 5,000 engineers. Uber runs a $3.4 billion R&D budget with dedicated planning teams and still got blindsided. Its COO went further, saying the spending was showing no noticeable increase in productivity. Which brings us to July. Meta began developing an internal project to rent out its own surplus AI computing power to outside companies, meaning Meta has more GPUs, the chips that run AI, than it currently needs. Meta stock jumped roughly 9% on the news. CoreWeave and Nebius, smaller neo-cloud companies whose entire business is renting out GPU time to others, fell about 15% each because Meta just became a competitor dozens of times their size. Analysts compared the moment to the late 1990s fiber optic overbuilding that preceded the dot-com crash. One commentator put it plainly: if Meta overbuilt, it's fair to ask whether everyone else did too. So going back to the Treasury Department's private assessment, unlike the dot-com crash, fewer retail investors are exposed to AI stocks this time, meaning if this bubble bursts, the pain lands more concentrated on big banks, hedge funds, and private credit instead. So Washington's public position is full speed ahead. Bessent has said the biggest risk isn't AI safety or job losses, it's China getting there first. Meanwhile, its private position, sitting in an unpublished report, says the entire financial system is now leaning on a handful of companies, making an extremely expensive bet that the productivity gains show up in time, while their own paying customers can't even predict what the bill will be next quarter. Thanks for watching.